the 50-year mortgage. President Trump recently announced it. I give him props, but this is a long time to be paying on a mortgage. I'm about 50-ish. I'm not going to get into details there. But there's at least one financial entertainer, I believe, that could be really stressed out about this. I can't confirm or deny that, but we're going to dive into an example today. So we're going to look at $1 million loan at 6.5% interest and just look at some math that you may not be aware of. So the payment on our example is $63.20 a month for the 30-year and $5,500 roughly for the 50-year. So you're saving about $700 a month, off to a good start. But then when you look at the interest paid, the total is about 1.2 with the 30-year and about 2.3 over that for the 50-year. So you got about twice as much interest that you're paying ultimately to save the $700 a month. But even worse is the equity. It takes a long time to build equity, even with a 30-year mortgage. After 10 years, you got about $330,000 in equity, and yet the 50-year is much worse at about $180,000 in equity after 10 years. So this leads to a discussion of an age-old mortgage banking problem for consumers, which is really, if the market dips 5%, you're underwater on that property. There isn't the equity to really support what you owe, which is a problem. But remember, the system isn't broken. It's designed this way. It's designed to route lots of money to large banks and corporations. And yet, we can also say that most conventional financial advice keeps you trapped and not wealthy for this reason. So if you like this kind of information, check out our channel, subscribe, and look at our other videos, and of course, stay tuned for future videos. I'm so glad you joined me today. I'll see you in the next one.